Welcome back to Smart Stock Sam, the channel where we cut through the noise, follow the smart money, and build trade setups that actually make sense. Today, we are going all in on HIMS and HERS Health, ticker symbol HIMS. Now, if you clicked on this video, you already know the headline, a potential $19 billion catalyst, massive insider buying, and a short squeeze that is quietly building under the surface. But here is the thing most people miss when they look at this stock. The real story is not what has already happened. It is what is about to happen next. So buckle up, because we are going to break down the fundamental transformation inside this company, the exact Wall Street divide on its valuation, the regulatory time bomb ticking toward late July, and then we are going to build a clean, actionable trade setup around all of it. Stay with me until the end, because the risk management section alone could save you from a very expensive mistake. Now, to understand where HIMS is headed, we first have to understand what happened to get it here, because this chart is one of the most dramatic recovery stories you will see in the healthcare space this year. Not long ago, this stock was absolutely obliterated. The FDA announced a sweeping crackdown on compounded GLP-1 weight loss drugs, and Wall Street panicked. Analysts called it an existential threat. Retail investors dumped shares. Short sellers flooded in, piling on the pressure and betting this company was finished. And then something remarkable happened. Instead of rolling over, HIMS ripped. The stock recovered over 36% in a single month, closing recently at $33.94 with nearly a 4% gain in one session alone. And here is the question you should be asking yourself right now. What does institutional money know that the average retail investor does not? Because that kind of violent, sustained recovery does not happen by accident. It happens when the big money figures out that the underlying business is far more durable than the headlines suggested. So let us talk about what is actually driving this recovery, because it rests on four very distinct pillars, and understanding all four is essential to understanding why this stock deserves your attention right now. The first pillar is market expansion. When the FDA tightened the screws on compounded GLP-1 drugs, most people assumed HIMS was toast. What actually happened is the company executed one of the cleanest strategic pivots I have seen in a long time. Instead of fighting the regulatory headwinds, HIMS went and secured landmark partnerships directly with the two biggest names in the entire weight loss drug industry, Novo Nordisk, the makers of Wegovy and Ozempic, and Eli Lilly, the makers of Zepbound and Mounjaro. That is an absolutely critical move. They stopped trying to compete around the regulation and started working inside it. The second pillar is corporate tailwinds, and this one is deeply underappreciated by most investors. Large employers across America are actively cutting coverage for expensive branded weight loss drugs. Sweeping changes are expected by 2027. And when those employer plans disappear, those patients do not just stop needing medication. They become cash-pay consumers desperate for an affordable alternative. And where do they land? Right on the HIMS platform, where the subscription model runs $149 per month, a fraction of what these drugs cost out of pocket through traditional channels. The company is not chasing customers. The market is being funneled directly to them. The third pillar is the global ecosystem, and this is where the story gets genuinely exciting. On June 2nd, 2026, HIMS completed a massive $1.15 billion acquisition of a company called Eucalyptus. This was not a minor bolt-on deal. This acquisition transformed HIMS from a domestic telehealth platform into a legitimate global digital health ecosystem, expanding their presence essentially overnight into the United Kingdom, Germany, Canada, Australia, and Japan. And alongside that geographic expansion, they launched Labs AI, an artificial intelligence-powered health assistant that can interpret 130 unique patient biomarkers to deliver highly personalized care at a scale that a traditional doctor's office simply cannot replicate. They are building an AI-driven health platform with a global subscriber base, and we are still in the early innings. The fourth pillar, and I want you to pay very close attention here, is what I am calling the regulatory horizon, and this is the hidden catalyst that I believe the market has not fully priced in yet. But we will get there in a moment. First, let us address the elephant in the room, because I know what some of you are thinking. What about Amazon? Is Amazon not going to come in and crush HIMS? This is actually one of the most common bear arguments you will hear, and when you look at it closely, it falls apart. HIMS offers a comprehensive continuous care model for $149 per month. Consultation, ongoing medical support, prescription fulfillment, follow-up, the entire ecosystem. Amazon's telehealth program, by contrast, is currently limited to simple prescription renewals. There is no end-to-end continuous care infrastructure. Amazon is operating like a pharmacy. HIMS is operating like a specialized digital clinic. That distinction matters enormously when you are talking about chronic conditions that require ongoing management. Could Amazon eventually build that infrastructure? Theoretically, yes. But by the time they do, HIMS will be 3 years further down the road with millions of loyal subscribers, a global footprint, and AI systems that learn from every single patient interaction. The moat here is deeper than the market currently appreciates, and with every passing quarter that HIMS deepens its AI infrastructure, that moat widens even further, making it harder, not easier, for a late-arriving competitor to simply outspend their way to the same outcome. Now, let us get into the numbers, because this is where it gets complicated, and where I need you to pay careful attention. The top-line growth is genuinely phenomenal. In the first quarter, revenue hit $608.1 million, up nearly 4% year-over-year. Total subscribers grew to 2.6 million people. That is impressive momentum by any measure, but here is the reality check. Gross margins fell, and they fell hard. They dropped from a very healthy 73% down to 65%. Adjusted EBITDA dropped to $44.3 million. Why? Because the pivot from manufacturing your own compounded drugs at high margins to reselling branded GLP-1 drugs from Novo Nordisk and Eli Lilly compresses your profitability. You are paying for someone else's product instead of making your own. To finance the Eucalyptus acquisition and cover this transitional period, HIMS raised $350 million through a 0% convertible senior notes offering due in 2032. Let me be direct with you. This company is taking on debt and accepting short-term margin pain in exchange for long-term market dominance. Whether that trade-off pays off depends almost entirely on what happens next month. Mark your calendars. July 23rd and 24th, 2026. The FDA Advisory Committee is convening to review what is known as the 503A bulks list. And in plain English, they are deciding whether to officially clear certain peptide substances for legal, large-scale compounding. If HIMS gets that green light, they can go back to producing high-margin compounded peptides in their own facilities, which would solve the margin compression problem almost overnight. Independent analysts project that this specific regulatory ruling could unlock a revenue opportunity worth between $10 billion and $19 billion by 2030. Think about that for a moment. A single government committee meeting, less than 30 days away, could fundamentally reshape this company's financial trajectory for the next decade, and the market is currently in the process of pricing in the probability of that outcome. Could the ruling come back negative? Of course it could. But ask yourself this: what are the odds that regulators ignore a market this large, backed by two of the biggest pharmaceutical companies in the world, and supported by millions of American consumers who need affordable access to these medications? The probability of a favorable outcome may be higher than the bears are willing to admit. And even a partial win, even a conditional approval on a subset of peptides, could meaningfully re-rate this stock in a matter of hours. Because of that uncertainty, Wall Street is genuinely torn on this stock, and the analyst divide is as wide as I have seen on any single name this year. On the bearish side, Truist has a price target of just $23, and Citi sits at $24. Their argument centers on execution risk and the margin deterioration we already talked about. On the bullish side, Needham recently upgraded HIMS to a buy rating with a $35 target, while Barclays came out with an overweight rating and a bold $39 price target, predicting significant revenue and EBITDA acceleration in the second half of 2026. The 12-month average street consensus sits somewhere around $26 to $27, which means at the current price of $33.94, this stock is already trading above what the average analyst thinks it is worth. When a stock trades above consensus, it tells you one of two things. Either the market is wrong and the stock is overvalued, or the market is pricing in something the average analyst has not fully accounted for. In this case, I believe it is the latter. So when analysts are this divided, the smartest thing you can do is follow the actual money. Let us look at what the institutions and the insiders are doing. Institutions control an enormous 82.89% of the tradable float. In the first quarter of 2026, we saw some genuinely significant conviction buys. Defiance ETFs purchased 7.42 million shares. Morgan Stanley added nearly 5 million shares. These are not small, passive index adjustments. These are active, deliberate accumulation moves. On the other side of the ledger, Capital World investors and Goldman Sachs trimmed their positions, and there was some C-suite selling. The chief medical officer sold over 23,000 shares at $35, and the CFO sold over 18,000 shares at $34.02. Now, before you read too much into those insider sales, it is critically important to note that both transactions were executed under pre-planned 10b5-1 trading plans, meaning these sales were scheduled in advance and are not a signal of panic or concern about the company's outlook. But here is the data point that I think tells you the most about insider conviction. Former Netflix CFO and current HIMS board member David Wells just went into the open market and personally bought 48,400 shares, spending $1.17 million of his own money. That is not a programmatic sale. That is a deliberate personal bet. When a board member with deep financial expertise writes a seven-figure personal check for shares on the open market, you pay attention. Now, I want to talk about the risks, because on Smart Stock Sam, we never paint a one-sided picture. There are real legal clouds hanging over this company right now. Beyond the margin compression we already discussed, HIMS has confirmed an active SEC probe into past practices related to compounded semaglutide. Additionally, the law firm Braunstein, Gewirtz, and Grossman has announced a corporate investigation into potential wrongdoing on behalf of HIMS investors. To be fair, these types of firm investigations are extremely common during periods of elevated volatility and often go nowhere. But combined with an active SEC probe, they introduce a layer of institutional hesitation that can cap the stock's valuation multiples. You cannot invest responsibly in HIMS without acknowledging these overhanging risks. The margin compression is temporary if the regulatory ruling goes their way. The legal clouds are harder to predict. Now let us shift to the technical picture, because regardless of where you stand on the fundamentals, the chart right now is telling a very clear story. At the current price of $33.94, HIMS has pushed above its 50-day simple moving average, which sits at $33.23. It is comfortably above its 200-day moving average at $27.95. The relative strength index is reading at 55.96, firmly in neutral to bullish territory with meaningful room to run before it hits overbought levels. The MACD is positive at 0.29, confirming that upward momentum is building and not fading. Across multiple technical timeframes, this stock is signaling a strong buy. But the most explosive data is not in the moving averages. It is in the options chain and the short interest, and this is where the real fireworks are hiding. There are currently 62.61 million shares sold short, representing 32.27% of the tradable float. To put that in perspective, at average daily trading volume, it would take short sellers nearly 3 full days just to cover their positions. Implied volatility is sitting at an extremely elevated 109.9%. The put-to-call volume ratio is a very bullish 0.73. And here is the detail that matters most for our trade setup. There is a massive wall of open call option interest clustering right at the $35 strike price, with 2,329 contracts sitting at that level for the July 2nd expiration. If buying pressure can push the stock through that $35 level, market makers are forced to dynamically hedge their exposure by buying shares, which creates a self-reinforcing feedback loop. Add 32% of the float in short positions that also need to cover, and you have a classic gamma squeeze setup. The shorts have already experienced $546 million in losses during a previous 41% squeeze. The question is, are they really willing to hold these positions through a July FDA catalyst? Because if history is any guide at all, the answer is almost certainly no. Short sellers are not known for their patience when the narrative is actively shifting against them. Here is our actionable trade setup for the June 29th through July 3rd window. The entry zone is between $33.85 and $34.10, buying right at the current consolidation area near the volume-weighted average price. Your primary support level is the 50-day moving average at $33.23. Your stop loss must be placed at $31.90. If price breaks below that level, the near-term bullish structure is invalidated, and you exit the trade. No arguments, no hoping. Discipline here is everything. The primary resistance and critical battleground is $35. If buyers can breach that level with conviction, the gamma squeeze mechanics kick in and we target a move toward $37, with the full bull case pointing at Barclays' $39 price target. For long-term investors, the 3 metrics to monitor are customer acquisition cost versus lifetime value, as the branded GLP-1 pivot matures, the outcome of the July FDA 503A ruling, and whether gross margins form a hard floor in the mid-60% range and stabilize through the Eucalyptus integration. Those 3 data points will define the next 12 to 18 months of this story. Before we close out, I need to be very clear about something important. Everything I have shared in this video is for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. I am not a licensed financial advisor, and every investment decision you make carries real risk, including the complete loss of capital. Always do your own research, consult a qualified financial professional before making investment decisions, and never invest more than you can afford to lose. HIMS specifically carries elevated risk due to the SEC probe, ongoing legal investigations, margin compression, and binary regulatory outcomes. Trade and invest responsibly. And that brings us to the wrap-up. HIMS is sitting at one of the most interesting inflection points I have analyzed this year. A company transitioning from regulatory headwinds to a global AI-driven healthcare platform, with a massive binary catalyst 30 days away and a short squeeze setup that could light the fuse. The risk is real, the reward potential is substantial, and the setup is clean. So here is the question I want you to answer in the comments right now. Do you think the FDA will greenlight compounded peptide substances in July? And what does that mean for HIMS? Drop your take below. I read every single comment, and I genuinely want to hear how you are thinking about this one. If this breakdown gave you value, hit that like button right now. It costs you nothing, and it helps this channel reach more people who are serious about building real wealth through the markets. If you are not subscribed yet, hit subscribe and turn on the bell so you never miss a setup like this one. And if you really want to support Smart Stock Sam and keep this kind of deep research coming, you can send a super thanks right here on YouTube. Every single one is seen and deeply appreciated. But here is what I really want to invite you into. I have launched the Smart Stock Sam membership community, and this is where the real edge lives. Members get early access to trade setups before they go public on the channel, priority replies to their personal questions, and custom analysis on request, built specifically for your portfolio and your trading style. If you are serious about leveling up your investing and trading, the link to join is in the description below. The community is growing fast, and I want you inside it. This is Smart Stock Sam. Stay smart, stay disciplined, and I will see you in the next one.